Hey traders, Nick Shaheen here looking at Alibaba. Today is 4/4, an epic day in the market all in general because we started a day looking at probably a drop of 500 points in the Dow, 40, 50 points in the S&P, and we ended up the markets being up 1.2, 1.5%, depends which index you're looking at. Bottom line is the travel in the Dow, I believe, was the range was about 900 points if you look at the Dow futures, and so that's pretty impressive. What caused the dip was just tariff talks. The reason I mentioned this is not to recap the market in general, because this is pertinent to the discussion here. Alibaba is obviously an overseas company, China, and the tariffs are really between the war, so to speak, that doesn't really exist according to everybody in the news, is between the U.S. and China. Basically, the U.S., the White House, the current White House, has had enough with the fact that China has had a bad reputation, bad behavior, I should say, with regards to stealing IP and intellectual property, and also having unfair tariffs. In other words, when a car goes to China, it is hit with a 25% tariff. And today the announcement was the Chinese retaliatory basically list to the list that the U.S. put out as to what they're putting on, and which includes another 25% on top of the cars. So this right here would tell you that, okay, the White House may have a point there. Why is there a 25% tariff when it's not reciprocal? So the fact that they're adding 25 on top of 25 tells you that one person's wrong and one person's right. So what's fair, what's not, all depends on perception. If from their perspective, I'm pretty sure we're doing something wrong. From our perspective, I'm pretty sure they're doing something wrong. Regardless, this guy's stuck in the middle. This is Alibaba. The ticker is BABA, and it has been trading in a tight range of late. This morning it looked pretty ugly. It did close still down 1.5%, but whoa, well off the lows. So it's interesting to look at headlines aside. Let's look at levels. So this poke today was fierce, and the volume wasn't as big as the last earnings dip, but decent volume. And the poke was close to the low of then. This is the February low. Today we exceeded that low. We also closed below the low here. So even though it closed high on the day relative to today, it's still a bad tick. If you want to say, okay, we retested the lows, well, here we are. So from here, that's what we care about. From here, it depends on your macroeconomic picture. If you're one that believes that macroeconomically the story is still good, and it's just temporary shenanigans that politicians do in order to negotiate their point in the media, then there might be some upside from here. But if you think that this is the top of the market, that we've topped off and we're ready to correct hard, then obviously this is not an entry point. So can I be somewhere in the middle? I can if I use options. So to me, I'd like to capture upside potential, but usually I do it with a lottery ticket, meaning I risk a little bit, an amount that won't break my piggy bank or break my heart. So the way I would do it to capture upside, I would do a debit call spread near the money, out in time. I've said it 1,000 times. So why near the money? Because I don't want to guess how far up is the bounce going to be. I want to start making money right now. Why out in time? Because if I do it near the money, out in time will cost me exactly the same as now. The only difference is my profits will come slower. But that's a double-edged sword. If my profits come faster in the shorter term, then they go away faster. So this will give me, if I go out in time, it'll give me some more conviction as to if I have a couple of bad ticks, I'm not freaking out, I'm not stopped out. Why don't I just buy calls? I could, but they're aggressive, meaning if prices fall, I lose money fast. If I want something that I could change into a naked call situation down the line, I would rather do a debit call spread, or if I'm familiar with options a little better, I can do call calendar, call diagonal, all of which are call spreads, whether straight up or calendar sideways or diagonal. If you need more information about all of these, let me know. We can have a special class on that one. So that's one way of doing it. Of course, traditional way would be just to buy the shares, but you're risking $172 right here, right now, with no room for error. You can put a stop loss, but what if you crash 20% in one tick, like we had on the flash crash? Then you'd be in world of heat, because the first tick will trigger your order will turn from a stop loss order to a live order, and whatever the next tick comes, you're out. So if you had it on the flash crash, you lost a ton of money, and if you had held on just a few minutes, then you would have been fine. Just saying, I don't like to use them. It's a good way of protecting yourself if you can't man the helm, but since I'm at the helm, I don't do those. So I could buy the shares and risk the money right here, or I could risk a lot less and still be long the stock. In fact, my upside potential in percent would be a lot bigger through options, assuming I guess the right direction. Same with the stock, okay? Difference with the stock is when I buy the stock, I own an asset. And for as long as the company is in business, then I have an asset, whereas the option has a time limit on it, thereby increasing the importance of picking the right time. And I'm saying out in time, so it makes my asset last a little bit longer. All right, having said that, there's another way of doing things. So what if I'm not so sure about the upside potential? I'm not so sure about the midterm potential, but I am sure that we're not going to fall apart as a market. Meaning we're not going to crash too far. We may correct 10-15%, but we're not going to disintegrate overnight. In which case, I can probably pick levels of support that will hold up in this stock. So this is a daily chart. Each candle is 1 day. And I can clearly see that there's a zone right there that is has held for a while. And by a while, I mean since, I don't know, last August. What is that? I can't read it. Yeah, August. So it's like a box right here, right? It's unscientifically. I'm just putting the flag here. So this earnings report, they told us something that we loved, and we thought, whoa, wait a minute. At 154, we had it completely wrong. Let's step it up. Which comes after this, where shortly after this earnings report, they said something that they have great things to come. And they delivered, because they said they had great things to come. The report came and they delivered great things to come. And they said, hey, we were right. It's going to continue. So we had 2 step-ups, thereby creating a void. That's why it's so important to hold this line, because if you lose this zone, you're going to fall to 150. Why 150? Because I look this way. So here's how I see it. Okay. I didn't come from Wall Street. I learned this all by myself, but this is pure logic. Okay. So here we said, that we completely mispriced it, they step up. Here they say we mispriced it, they stepped up. So now we have a zone of support right here with a small gap below right there, right? So if we lose the zone, then they're going to fall back to the first trench, the nearest trench from which they came, which is this one. Okay, this one. Short term, I like them longer. Like this is pretty long. If they want to use this as a base for higher prices, that's a lot more solid than this on the way down. So this would be the first zone I would look at. Okay, so that is, if I wanted to go long via selling puts, I'd want to hide below this one. That's for sure. That's the first line of defense. And if that fails, there's another one right here. Again, that's too short. Like this one is long, this one is short, this one is short. But nevertheless, it is a price action zone. So somewhere around here, I'm going to call it, what is that? 138-ish? Okay. So 150-ish, 138-ish. Notice I say ish. It's not a science to me. Okay. Here's another zone that's also short. Well, this stock rises so fast that they keep changing the game. So rising fast means that they are weak hands, meaning if somebody got a lot of fast profits, they're a weak hand because they don't care. The first couple of red ticks, they're out. They want to protect their profits. They haven't had time to hold it. They're not attached to it. They just got it fast. They don't mind booking some of it or most of it. So here are 3 zones behind which I want to hide on the short term. So how can I do that? Then I can go to the options market and see what contract I can sell in order to get a decent return on my risk. What's decent return? All depends on personal preference. Depends on my ability to take risk, whether I do a sold naked put or a sold put spread. My tolerance for risk, meaning where do I put it? I'm conservative. I like to put it way out where I have a 90 theoretical chance of winning, meaning if you're familiar with the bell curve of anything, you have events that happen. This is They talk about standard deviations, right? Plus or minus 1 standard deviation, everything happens in here. Plus or minus 2, a lot fewer things happen here. And outside of that, outliers happen there. So you've got 68%-ish, and then up in the 80s, 90s, where I'd like to sell risk, meaning something that's not likely to happen. So in this case, this is where all of the stuff comes into play to pick A, your timing, here, out in time, or B, level. So this is where it's important to do homework and assess the personal situation. So for me, I like to be conservative. I want time on the clock so I don't have to fight the war in the trenches, so to speak. I'd rather be in headquarters with binoculars or a TV screen or something where I'm not in the trenches. So I don't play the current week's expiration just because if something goes wrong, you can't fix it. I have to sweat every tick. Whereas if I'm, for example, I was short puts in Boeing this morning out in September. I didn't even look at them on the 5% dip from the stock this morning because I knew where I had sold it. I knew what happens there, and I know the value of the company. In this case, speaking of value, let's look at the value. Where are we? Boom. There we go. So real quick way of doing it, just pick up Yahoo Finance, whatever you want. They'll usually have metrics. And the one thing to look at is price to earnings. So this one is 42. Sounds high. Apple's like 17, 18. But this is a little different than Apple. That's a growth company still. Think Amazon-ish, not so much. Amazon is an extreme. It's probably 300. I haven't looked at recently, or CRM or something like that. But this is a growth stock. So I would probably compare it to Google, compare it to Facebook, for example. Not Netflix. It's somewhat of a similar, unique situation. So with growth stock like this one, I don't demand low PE. I demand good growth. When they stop growing, then I'll start saying, show me the money. So if a startup company comes to you and says, hey, I'm growing like crazy, but I'm losing money, you say, that's okay. You're a startup. These are not startups, but somewhere in between that startup and a matured company that's a valuation play, there's these guys. Okay, so they're still accelerating, but they're not startups. And in this case, they're not losing money, so that's great. Amazon is a completely different beast. It's a perpetual startup. Nobody believes me. Very few people. It's a startup. Every year they start up new businesses. That's why they spend all the money they have into new businesses, but they're not losing money, which is great. So it's like a perpetual startup that doesn't lose money. That's an outstanding growth trajectory. So dangerous stock, but it's more dangerous to short it. All right, back to the story at hand. So valuation is not that crazy, right? And then I have to go look at what the experts think about it. Why do I do that? Because I want to see if the expectations on Wall Street are overdone or underdone. Why? Because or don't really care, because they tend to issue notes, reweighting it this way, changing the price target that way. If everybody is overexcited about the price and the price is already at the upper end of the range, there might be some headlines. So I'd like to build an extra buffer or two there. And that's it. So in this case, I don't see anything special to that. So I do like the company. It is caught in the crossfire, so it is risky. It does have voids below, and I just showed you the couple of void areas. Back to this one. So there's a little void here, so it could suck it down to that. So I'd like to hide down below. So this is where I do my homework. I learn the options, and then I pick the levels, and I sell the risk. Now, I have to put a caveat here. I never sell risk I can't afford to own, meaning what? When I sell a put, I'm committing. Most people are familiar with buying a put. So if I own shares of Alibaba and I want to protect myself below 150, I'll buy a 150 put. And then if the price falls below it, while I'm holding the put before it expires, then I own the right to sell the shares at that price, even though the shares went below. So if it falls to 140, I just saved myself an extra $10 of losses, minus what I paid for the put, because somebody else said, hey, you know what? I will buy them from you if it falls to 140. Why would they do that? Because they do the homework and they disagree with me. They're like insurance people. They know that they can sell enough of these where most of them will just expire worthless and they'll make money. They'll have a few losses, but overall they'll make money. That's me. I do my homework and I sell the puts where other people are scared. So this morning, while Boeing was falling, I would have been the guy selling puts into that fear. If somebody's thinking, oh my gosh, I've got to protect my profits at 250, sold to you, I'd go out and say, I'll buy that from you. Here, I'll give you until September. If it falls to 250, I'll take the shares from you at 250. So what does that mean? It means I committed to that person on the other end, who I will never meet, that I will buy the shares from them at 250 should it fall to 249 or 0. So I'm on the hook from anything below 250. Can I protect myself against that? Sure. Complicated answer, but there are a lot of ways where I don't leave myself naked like that without having a credit put spread. That's other ways. An alternative to selling naked puts is doing a credit put spread. You've heard of the term probably bull put spread, where same deal. I sell the puts at 250, but guess what? I'm a little bit chicken, so I will buy puts below it to mitigate my risk. All right, so this is the story as I see it for Alibaba. But again, you have to start with the macro. What does the world look like? And see how you agree or disagree with the thoughts that, hey, all stocks are falling. Guess what? If all stocks are falling, I don't do any of this, because this one is going to fall too, regardless of levels. But if I don't think that the world's going to fall apart in the next few months, I'll take a risk or two with a buffer, meaning I leave myself room to fall. So if I pick, I haven't checked the premiums, but if I pick 130, I leave a 20% buffer between current prices and where I'm taking the risk. So worst case scenario, I collect the premium and the price falls through. I keep my premium and I own the shares at a 20% discount. So I'm getting paid today for the opportunity to own the shares at 20% discount. That's only good if I believe that the stock market in general is not going to fall apart. Nick signing out. If you have any questions, let me know.